Welcome back to Facts Over Feeling on this 9 Innings podcast station. And today we're talking about the middle class millionaire. Why am I having this conversation? Because $1 million is not what it used to be. Think about it. Everybody has a number. Oh, if I just get to $1 million of net worth, if I get to $1 million of assets, I will be fine. But that is not the case today because we have inflationary pressures, rising prices across the globe, and all these different things that are coming to a head that is making that $1 million worth less. So today on this Facts Over Feeling segment, we're going to talk about what $1 million actually means, how it's changed over time, and some of the things that you need to consider when we talk about building assets. So without further ado, buckle up. Today, everyone, we're talking about the millionaire or the middle class millionaire. And the reason why I'm calling it the middle class millionaire is for a few reasons. One reason is because $1 million doesn't buy what it used to. The $1 million that a person had in 1980 or 1990 isn't that exact same $1 million that you have in 2026. Why? Rising prices, elevated oil prices, all these different things that come to the consumer have decimated real returns. And you have to do things that offset that. But before we go there, I want to show you something that I think will be very valuable in this conversation. And the value is going to be in knowing how $1 million has changed over time. So right now what we're looking at is a CPI inflation calculator. And what we're going to do is do a very basic understanding of what these dollar values actually mean. So what you're seeing on the screen here, you have January of 1980, and we're going to take it all the way to today, which is 2026 of April. And that same $1 million today is equivalent to $4.2 million or $4.3 million of assets. What that's telling you is that a millionaire today would have to have $4.3 million to have that same buying power impact to live a millionaire lifestyle. That should wake you up a little bit, have an understanding of what this true purchasing power impact actually means. Let's take it a little bit further. Let's take it to the year 2000. If we go in, almost $2 million of assets is equivalent to what someone had in $1 million back in 2000. If we're gonna have that as an example, and let's take it even a little bit further. I think even more recently in 2020, you would have to have almost $1.3 million in 2026 now to have what someone had in 2020 if they had $1 million in 2020. Now, why is this important? This is important for a few key reasons. One key reason is that inflation is the silent killer of most financial plans. Again, $1 million today is not the same thing. Think about it for a second. That same number sitting in your account, that same 7 figures, doesn't buy you what it used to. That's why I call this episode the middle class millionaire, because now you're basically middle class if you have 1 million, 2 million, or even 3 million of assets, because you're typically not able to afford the cost of the things that are associated with everyday household spending. Because many of the households, it's not a luxury lifestyle anymore. It's just the baseline. Now, before everybody gets upset at me, again, I get it. Don't kill the messenger. I'm not saying $1 million isn't a lot of money. It absolutely is. Most Americans will never accumulate $1 million. What I am saying is that $1 million is no longer a guarantee of a certain lifestyle that you're wanting. Let's use in the retirement for an example. Imagine a retiree who has $1 million invested. Sounds fascinating, sounds great, sounds fantastic. Well, if they follow the traditional 4% withdrawal rule, the $40,000 a year before taxes, adding some Social Security, they're doing okay. But let's layer on top of the things that we know that are happening right now. Property taxes, especially here in Texas, they're coming they're not necessarily coming down that much, but there's more exemptions and stuff that you can qualify for. But property taxes are still rising across the country. Healthcare costs are rising across the country. Homeowners insurance is definitely rising across the country. Food, utilities, and travel, unexpected expenses. And now for most retirees, we have long-term care. So suddenly that $1 million nest egg starts looking a lot less like wealth and more like a resource that must carefully be managed. So this is where I think many financial conversations go off the rails. We spend too much time thinking about a number, thinking about becoming a millionaire, not enough time talking about maintaining purchasing power, because purchasing power is what actually matters. Your lifestyle is determined by what your money can buy, not by the number pointed or printed on a statement, not something that we point to in a statement and say, hey, this is what your account did. No, it's the silent killer of assets. Again, inflation is the silent killer. Most people don't notice inflation all at once. It's gradual. It's the grocery bill that creeps a little bit higher. I know a lot of you have noticed that, hey, I'm going to the grocery store, and what used to be $100 or $150 worth of groceries, now it's costing me $250 to $300, right? The insurance premiums that are jumping up across the country up 20%, the 2%, the 3% wind and hail deductibles we have now here in Texas on full replacement cost of your home is costing you $10,000 to $15,000 just to replace your roof. The restaurant meal that somehow creeps up to $80 versus $50. Utility bills that are going up across the nation, not because of just data centers and everything like that, but just because of demand increases. And we have an old infrastructure here. It doesn't seem that catastrophic, but collectively, all those things compounded on top of one another can be an issue. So let's start talking about why this matters from an investment perspective. One of the biggest mistakes I see is people focusing entirely on safety while ignoring inflation. I know everybody's talking about, well, the market's bound to correct. It's bound to correct. Yes, it's bound to correct. It always goes up. It always goes down. Yeah, et cetera, et cetera. Safety matters. In fact, I have always been a huge proponent of having cash reserves on your balance sheet. I generally recommend 9 to 12 months for most individuals who are in their working years, and over a year's worth of cash and cash equivalents for retirees. Why? Life happens, jobs are lost, businesses slow down, unexpected expenses show up, like your AC may go out, your car may have issues. Cash gives you that flexibility. But once that emergency reserve is established, there's another risk that must be considered, and that is the risk of inflation, because many people sitting idle in cash are losing purchasing power over time. The math isn't complicated. Back, and I was on Yahoo Finance having this conversation, we called it T-bill and chill, because back when rates were elevated over 5%, you can get a 5% T-bill and you can sit there, and inflation was roughly around 3%. You were getting 2% real returns. We were happy with that. But now with elevated inflation, and now you have a lower yield on the front end of the curve, you're getting negative real purchasing power on those dollars. So they're forcing us out of the safe investments into the risk assets, and that's why you're seeing rising prices in regards to the stock market. Now, again, that doesn't mean we all have to go 100% risk. No. But that's why investing matters, because we have to keep up and outpace inflation, like I just mentioned to you, if we want to maintain our purchasing power. No, stocks don't always go up. I get it. But because historically, when prices move higher, what happens? We pay more. That goes to the corporate balance sheets. They have higher earnings. Asset prices move higher, and we get the benefit of rising stock values and asset values to offset or outpace that inflationary pressures. Consumers are paying more. Companies collect more revenue. Yes, it's a positive thing, but it's also a negative thing because we're actually paying more money. But that's something that must be done to outpace a lot of these rising prices. Now, again, like I said, if earnings rise, the value of those businesses tend to rise over time. In other words, owners often benefit from the same inflation that consumers struggle with. That is why investing has historically been such an important component of wealth building. You aren't just saving money. You're purchasing ownership and productive assets. But here, I want to make sure that you understand this. That does not mean markets are risk-free. We understand that markets are going to go down. They absolutely will go down. Markets decline, corrections happen, bear markets happen. But over long periods of time, productive assets have generally provided one of the most effective ways to combat inflation. And that's why the millionaire conversation needs to evolve. The goal should not be, I want to become a millionaire. The goal should be, I need to maintain my purchasing power over time, because the number itself is meaningless without context. A millionaire today is not $1 million in 2000. It's not even $1 million in 2020. The goalposts have moved. The challenge for investors is recognizing that reality and planning accordingly is pivotal. So when someone says they want to be a millionaire, my response is typically, what kind of millionaire? The millionaire in 1985, the millionaire in 2000, or the millionaire from today? Because those are three very different lifestyles. Facts over feelings. That's why I have these conversations, because I want to speak to people in this factual context. The facts tell us that inflation has changed the value of money. The facts tell us that the retirement risk has shifted from corporations to employees. The facts tell us that pensions are disappearing and individuals are carrying more responsibility than ever before. And the facts tell us that building wealth today requires more planning, more discipline, and likely more assets than previous generations. That isn't pessimistic. That is a fact. That is a reality. The sooner we understand that, the better prepared we'll be for the future. My goal, again, today, this has been the millionaire, middle-class millionaire. I keep getting that confused, but the middle-class millionaire. And I want to leave you with these key points. 7 figures is not the same as it used to be. Just because you have $1 million doesn't mean you have $1 million of purchasing power. If I reverse engineer these numbers, those numbers will look drastically different. Matter of fact, I'm going to do one really quickly. If I reverse $1 million today, and I compare that to just if I go back to just 2020, $1 million today versus what that number looked like back in January of 2020, that number looks more like 793,000. So what that's telling me is that if I had $793,000 in 2020, I basically have the same buying power of $1 million today. That is important. So one, dollar values, inflation. Inflation is a silent killer. 2, it's important to maintain purchasing power. So don't think about the number. Think about maintaining purchasing power. 3, don't think about, I want to be a millionaire. Think about what that $1 million means and how that can keep up with overall cost increases. And 4, make sure that we're maintaining our investments, not taking too much risk, but making sure that we're outpacing that inflation so we can maintain our lifestyles. And lastly, get with someone that knows that this is something that's important to you, because if they're not talking to you about this and they're just talking to you about possibly investing and listening to you like, I want to remain safe over time. Think about it this. If you're a retiree and you're talking about, I want to be in bonds and I want to be in a safe environment, you may lose out to inflation. So it's important to have these conversations with your financial advisor, with your certified financial professional, with your retirement income certified professional, and with a tax advisor to understand why these numbers matter. Thank you guys for listening. Stay aware, stay ready, and I'll see you next time on Facts Over Feelings. See you soon.